Welcome one, welcome all to DeFi Crypto and Airdrops. I am Mike, aka Veteran Crypto, and this is David and Jake Call with Metrics Finance and Builder Wealth and DeFi University. And so, before we kick things off, how are you gentlemen doing?
Doing great.
Awesome. So today we're going to be talking a little bit about rate cuts. We're kind of get everyone's expert opinion on where we see the markets going from here, and hopefully we hear a little bit of positive news, but we'll see. But before we get too far down the road, let me kick this off. Let me share my screen real quick. Want to make sure that we hit. Let's add David to this one. All right. Let's a little bit of this. Hey, how's it going, Ellie? Appreciate you being here. We are also live on pump.fun. So
okay. Switching up the platforms today.
we're trying to branch out, trying to grow, trying to scale, just trying it out. I'm not huge on meme coins, but you got to go where the eyeballs are. So we'll let's see. So real quick,
Dang, we got cut
Oh no!
airdrops
All
is
this.
What's that?
Mike, you got cut.
Oh, I got cut off. All right. So basically, I just want to hurry and go over our socials. So if you want to join the conversation and jump in the chat and ask questions from our panel, if you want to jump over to DeFi Crypto and Airdrops on YouTube, you can come over here, join the conversation. You can also, click over and check out Discover Crypto, Blockchain Report, and Blockchain Basement, our brother channels. And we also have links for both DeFi University, which is David's DeFi platform where he teaches everything from beginner to advanced strategies and DeFi, and also a discount link for Metrics Finance, which is a great tool, DeFi aggregator that helps you track your portfolio and find profitable pools. So this is our account over on pump.fun. It's just DeFi Crypto and Airdrops. If you want to look us up, you can also join our Discord. We have a great community of people in there that are more than happy to help you with any questions that you have. We're always talking about different profitable pools. And then, of course, DeFi University at school.com. DeFi University, link in the description on our YouTube channel. There is also the DeFi University.xyz that David has been building out with news and a lot of great tools to use in DeFi. So, impermanent loss calculators, APY calculators, yield farming calculators. I know that he's planning on adding our looping calculator that we built. So a lot of great tools in there. And then, of course, Jake's Metrics Finance. This is by far the best tool that I've seen as far as tracking portfolios and liquidity pools. And again, simulating positions before you actually enter your liquidity with real-time data so that you can better understand if it's going to be a profitable position for you or not. So with that, let's go ahead and jump on into this. Either one of you gentlemen want to add anything to what I just put out about your platforms?
No, I wanted to say David's stuff is shaping up great. He has like a AI model that's like learning from itself basically and putting out like a bunch of posts and over time learns from itself, which is pretty cool. And like over at kind of metrics and build wealth, we're building some stuff too. So like on the metrics side, we're building stuff that's going to help you like more on the strategy, like you can ask a LLM like, hey, how could I go about selling ETH at this price using liquidity pools? And it puts together something for you. Whereas like on the builder wealth side for our paid offerings, we're putting together LLMs that are traded on all of our content, all of our like coaching calls that we have with clients and in the group and stuff like that. And we're getting it built out like professionally and everything, which is pretty cool. And it's nice to see it shape up. And I'm happy to share some of that later. But pass it on to David.
Yeah, so I'm really looking forward to seeing the tool that you've been working on, Jake. I can't wait to see that launch, man. That's going to be great.
Yeah.
And, the AI, being able to use AI to help you with your decision-making process, dude, that's like next level stuff. What I've been working on in DeFi University is really getting the courses on the school all up to snuff. So I've been putting in a lot of time getting those courses ready. Now, there's a free course on the website. The tools page on the website is a work in progress. And then the blog posts, those are all AI generated. And Jake, as you mentioned, it ingests content from about 120 different sources. And then over time, it's going to learn and become better. So that's, what I've been working on. But you guys, this is an FOMC day. So, we got some Fed stuff to talk about, don't we?
We do. We
Yes,
do.
we do. Yes, we do.
Well, let's jump straight into that. Because I'm really curious to hear what you gentlemen think. Let me pop over here real quick and see what the markets have done in the past few minutes since I looked. It looks like definitely some volatility. So when I was watching live, Powell talk, the markets took a bit of a dump. It immediately recovered and pumped, and now we're dumping again. So let's go ahead and just jump into this. And Jake, you tell me what you're seeing right now, and kind of your take on what Powell put out, and all of that.
Yeah, I mean, I think it's kind of like what we talked about last week, almost what do you call it? A sell the news event, basically, where the probability that we were going to see a 25 basis point rate like cut, like it was 95%, I think, according to Poly Market, and I think it dropped down to actually like 85 at one point, and the other 15, it wasn't, I think like 10 of it was at there would be a 50 basis point cut, and then 5 was also at like there would be no rate cut, basically. So basically, I think this was already priced in as of like last week. That's kind of like why we saw a lot of the market moving. And now we're retracing, which is completely normal, I'd say. Nice little setback. And when we think historically, we think September is typically a red month. So like, I almost feel like we'll continue to almost decline throughout the remainder of September, because when I look specifically from September 1st on Bitcoin till now, I actually think Bitcoin's going to be somewhat green, because we're at 115 K right now on Bitcoin. September 1st, we were trading at about $107,000, because September 1st hit that dip right in the head. So like we'd have to drop a 5-6-ish%, actually a little bit more, nearly 10%, just to get down to that red month. So I think like for most tokens, September's a red month. For Bitcoin, it's green.
All right, David, what is your thoughts on what Powell had to say? Were you feeling it was more dovish, hawkish? Where do you see us going from here?
Yeah, so there's a couple of things that I'm looking at here. The first thing was, Fed Chair Powell, he described the 25 basis point cut today as a risk management cut. Now, you got a couple of items, that are competing here. You've got, the labor market, which has, according to Fed Chair Powell, it is no longer solid, and that makes sense, right? Because a lot of the job gains over the last couple of years have been revised away. So, we got a revision last year uh, into the September FOMC meeting where over 800,000 jobs were revised away, meaning those jobs existed only on a spreadsheet somewhere. And then just a couple of weeks ago, we got another revision, the largest revision to jobs, downside revision to jobs in history. And it was like 911,000 jobs were revised away. And so remember, the FOMC, the Fed, they've got a dual mandate: price stability and full employment. So that means keep inflation in check and make sure that people are employed. And, you know, those two mandates are in competition with one another now, because the inflation rate is still above the Fed's target. and yet we're seeing the labor market start to deteriorate. So, Fed Chair Powell, and this is in the face of GDP seemingly starting to accelerate higher and with the stock market at all-time highs. So, Fed Chair Powell now has to prioritize either the labor market or fighting inflation. And it seems as though he is choosing the labor market and cutting into what seems to be a weakening labor market. Now, this is really interesting for us as digital asset investors because last September, when Fed Chair Powell cut by 50 basis points, and this is a risk that I've been talking about for the last couple of weeks in DeFi, is, last year when Fed Chair Powell cut in September by 50 basis points, the long end of the yield curve pushed much higher and quickly. And that pushed the US dollar higher by nearly 10%. Now, it ended up giving back all of those gains, the dollar did. But I think the last risk, you could kind of think of it as like the final boss here, okay, before we get like a true alt season. I think the last risk is that we get some type of a pop to the upside out of the dollar, out of the US dollar, as a result of long end rates moving higher. So remember, the FOMC, the Fed, they don't control or set the yield on 30-year bonds or on 10-year notes. They control the very front end of the curve. So they set the policy rate at the very front end. They don't set the rate on the 30-year. So what happened last September was the Fed cut by 50 basis points and the long end moved higher. And that pushed the dollar higher, and we saw a little bit of a correction. So I'm just thinking that if we get a bounce out of the dollar, and over the last couple of sessions, the dollar has actually broken down below and then bounced back up above long-term support. So I'm just thinking that if the dollar bounces, it would probably be because bonds and notes are selling off. And I think that could precipitate a correction in stocks and digital assets. But I think that that would be the last buyable correction through the rest of this year. So
Okay.
I think that digital assets and the stock market move much, much higher through the rest of this year. And the last risk that I really see here,
Preach.
yeah, man. I look. I think the targets that some people have, Mike, of like $200,000 Bitcoin. I think that's actually attainable this
Yeah.
year. And I think that we've seen this before. We've seen Bitcoin rally by 90% over the course of 90 or 100 days twice this cycle. We saw it in January of 2024. Bitcoin was up by like 90% over the course of 90 days. And we saw it at the end of 2024 with the election, that big rip higher. You could also say that, the move that we've seen from the 74K lows, that was like a plus 70% move from 74K to 124.5. That's a big move. But I think that like if the dollar rallies, that would be the last potential buyable correction before alt season, because hey, it's time for alt season, you guys. Like it really is. Bitcoin dominance is
I think
like
alt season might be
about to
late.
break.
I've been waiting for alt season, and our dinner reservation was at 8, and I think it's like 8:15.
No, Mike. I think we're on the precipice of alt season, and I agree with what Jake said earlier that we might see some type of a buyable correction through the rest of September. But man, like in the post-halving year, September is typically red,
Red.
but
Yeah.
then October and November are just blow off top
Mhm.
months where you
So,
get
well,
alt
so
season.
really quick. I wanted to do a quick shout out to Drew, over at Blockchain Basement Discover Crypto. Huge supporter of the channel. Big part of why how we got here. So just want to do a quick shout out to him. But one of you, real quick, Stan asked this question, and it's something I think a lot of people out there are probably wondering. Either one of you want to tackle this? He just said, could someone translate Powell's claim employment decline was attributed to immigration?
I mean, like, give me a break, man. Like, come on, dude. Like, it wasn't attributed to immigration. Like, I think that's kind of a ridiculous statement.
Hmm.
I get the sense that those 800,000 jobs that were revised away last year and the 900,000 jobs that were revised away this year, I think that was just the BLS, that those jobs existed on a spreadsheet.
Hmm.
Um, I don't think that you can attribute that to President Trump deporting 300,000 illegal aliens. I don't think that the maths.
Another thing is, and not to get controversial or anything, but a lot of those are undocumented jobs, that wouldn't necessarily be on the books. For example, if
Very, very true.
like lawn mowing companies, stuff like that. Like that,
Hmm.
I wouldn't say the U.S. government technically considers that like on their books under the employment numbers job, but I could be wrong. um, or cleaning or something like that. One of the avenues that is typically taken. Um, but yeah, I mean, I get a notification a couple minutes ago. Apparently, there is a golden statue of Trump holding a Bitcoin placed right outside of the U.S. Capitol right now. If we want to flip over the screen share, Mike, I can show you
Yeah,
this.
yeah. Go ahead and share that.
Uh,
There we
here we
go.
go.
Wow, man, that's great, dude.
Is hilarious. But yeah, I mean, if there's anything else to cover relating to the overall like kind of markets and stuff like that, I wanted to share um, these charts that I've been looking at on BitBo. Now, these are like purely technical based on numbers. These aren't going to factor in a lot of fundamentals. Here we go. I just switched it over, Mike. Sorry. But basically, these charts essentially use all the previous technical data from previous cycles, from predictors and stuff like that, to generate a potential price prediction and tops for Bitcoin. So when we're looking at this one, just at the Bitcoin cycle repeat chart, what it's essentially saying is right now, our top is like $123,000, and if we were to look specifically, let's just say right over here where we're expected to peak, it's expecting Bitcoin to kind of move to $127,000 in October, which I think is actually really low for where we can go. I think Bitcoin has the potential to go significantly higher than $127,000, obviously. But I also think to some degree, it's somewhat reasonable. Like, being at 150K or so, there's a little bit of a difference there, but that's where I would expect the market to kind of top off at. And then another thing that we have is this kind of chart over here that models the stock to flow, the stock to income, the power law, and the HPR rainbow. Sorry. And when we follow that model, and if we assume based on this period, October, halfway through October, I think, which is what we were discussing, David, Bitcoin
Yep.
peaking kind of middle of October, and then alts rallying a little bit after that, and then kind of peaking about a month after. I'd say that's pretty in line with what we could see. So let's look all the way back right here. It's showing stock to income is at $492,000, which is completely unreasonable. Stock to flow is 365. Power law a lot more reasonable at 133,000, and then the rainbow chart at 93. So I think if there's any reasonable prediction based on technical analysis or anything like that using these specific charts, it's the power law chart, which is showing about 130,000. As far as price predictions go, it also gives us a list of analysts. Saylor's pretty bullish at 13 million over the next 21 years. And then Finney, sorry, is at 10 million. Plan B at 65 to 524, which is a pretty broad range. Jack Dorsey at a million or so. I think reasonably, if we look at this market in specific, we're around 150K. And more recently, I'm expecting a little bit more than that, a little bit more bullish than that. But 150 is where I start to kind of ladder out. Any kind of thoughts on these charts, David, or what you've seen in the past that
Yeah, so those Bitcoin uh, cycle top indicators, all of those different charts, um, I don't really subscribe to any of them. I
Yeah,
think that there are problems with all of them.
there are.
But what I think about more is, if I'm a bond investor, if I'm investing in, U.S. government bonds, and I'm sitting on like unrealized losses on those bonds, what I'm really thinking about is, when will Bitcoin start to absorb bond flows? That's what I'm thinking about, and it's really difficult to predict something like that, and also really difficult to know even if you're seeing those flows. I think that the best way to know would be just to take a look at price action. If there are really big up days, I think that makes sense that maybe you're seeing some bond flows. But like, dude, I could definitely see Bitcoin at 200K by the end of the year.
Okay.
Like, absolutely. We've seen, plus 90% moves out of Bitcoin over the course of a couple of months,
Yep.
several times this cycle. And it would not surprise me if Bitcoin rips above 124 and then we get that exuberance. You see, that's the thing. We haven't seen that yet. We haven't seen like the return of retail yet.
Yeah.
We haven't seen the we haven't seen alt season yet either,
Yeah.
and we're at the very end of the cycle. So this, October, November, this is when we should be seeing these blow off tops. So
So
yeah,
that
man. I mean,
actually, David, that actually brings me to my next question. So, we haven't seen alt season yet. And there's, I won't get into all of the details, but there a lot of variables have changed this cycle compared to previous cycles, with regulation and institutional money and things like that. Where do you see this cycle going? I know that we've kind of talked about it before, but I definitely feel it's appropriate to discuss potentially how this cycle could be different. It could be, a lot of people talk about a super cycle, an extended cycle, all of these different things. What are your thoughts on time frame? Could we be looking at an elongated cycle?
for sure. 100%. Bitcoin, Ethereum, digital assets are no longer the speculative gamble that they used to be. We've got these ETF products now, and these digital assets are being accepted into TradFi portfolios. We're starting to see institutions allocate to these digital assets, and I don't think that that slows down. I think that speeds up. And so it would not surprise me if we see some type of blow off top, but I think that a quote unquote bear market would start from a much higher high. So, like, a bear market in Bitcoin could look like this. We have a blow off top to 180K, and then we pull back to 120. So like that's kind of what I expect a quote unquote bear market to look like in Bitcoin. And I think that, the credit impulse coming out of the United States and China, and also the EU, but to a much lesser extent, I think that the credit impulse that we're starting to see in the US is just going to be too great. People are talking about Fannie and Freddie being, taken from, a government entity and turned into a public corporation, and then removing the SLR, so that banks can essentially like
What's the
buy
SLR?
a supplementary leverage ratio. So it allows, if that is removed, then banks would be able to essentially buy U.S. Treasuries on infinite margin. So they've
Okay.
got infinite leverage to buy as and create a ton of credit. And then if you've got also Fannie and Freddie Mae, which are going to, according to what I've read, become public entities, and then be able to issue essentially, government-backed mortgages, then like that's a form of credit creation. That's credit impulse. So it just seems as though, US dollar liquidity is going to significantly increase, not just over the next couple of months, but like over the next 18 months, over the next 24 months. And we're seeing that as stablecoins are starting to become adopted and banks are starting to custody crypto assets. Like the entire digital asset space is starting to see like real adoption. So I don't think that we see a negative 80% bear market for Bitcoin. And I think that when we do see a bear market, it's from much higher highs. So yeah, I'm very, very constructive over the next 3, 6, 12 months.
That's a good take, David. Because as we mentioned before, like we're definitely going to see a pretty big drawdown, in my opinion, but it's not going to be the 70% that we typically see, right? It's going to be significantly less than that. So even if we say,
Now,
well, yeah,
real quick, you just mean on Bitcoin, not alts and
yeah, alts will
okay.
see a much bigger drop than Bitcoin, obviously,
Okay.
and same thing with Ethereum. Um, But like, even if we were to see a 50% drop on Bitcoin, a 50% drop on Bitcoin from say $200,000, like what we're talking about, David, is going to put us at 100 grand still,
Right.
which is significantly, if we bottom at 100 grand, like imagine the movement for Bitcoin from there, and at the end of the day, the people buying at 200, they just have to hold that thing out.
I
Um,
know.
but but that still puts us in a pretty good position, basically. And one of the things that I wanted to like say, contrary to like I guess the plus 80-90% move to get to $200,000 for Bitcoin, do you think, because I do agree there have been times where we run up 90% in the time span of a couple months. Do you agree that that's still possible, though, David, considering we now have a $2.3 trillion market cap on Bitcoin? Or do you think we're at a point where we're going to see significant diminishing returns, basically, where it's going to be much harder to go up that much and it's going to take a lot longer?
You know, I think that institutions are just starting to allocate to digital assets now.
Okay.
And although, obviously $2 trillion is a massive sum of money, right? That's a lot. But what's the size of the bond market globally? What's the size of the just the US equity market? I'm pretty sure it's like the US equity market is like what, like 100 trillion or something like that? Or I don't know, maybe I just made that up. But the point that I'm trying to make here is that the equity and bond markets are much, much bigger than Bitcoin's 2 trillion. So even a 3 or 5% allocation from these large institutions with multiple trillions of dollars under management, even a 3 or 5% allocation, I think would push Bitcoin much, much, much higher.
Okay.
So, like, yeah, it would not surprise me to see Bitcoin rip higher by 100% over the next couple of months. That wouldn't surprise me. And yeah, to see it go from 2 trillion to 4 trillion over the next few months through the end of this year, for sure, we could see that.
So I got what I think is a really good question from the chat. Is asking, what do Jake and David think about instead of laddering out into stables, instead going into something like PAX G to avoid the diminishing buying power of the dollar and the possibility of destabilizing?
Yeah, it's not a bad idea whatsoever. It's just the consideration is gold is obviously sitting at all time highs right now, or at least near them.
Very hot.
Yeah, so it's like we have to determine, is gold fairly priced, and that's not going to be in my kind of scope of what I can do and predict, because I don't analyze the gold market. But I think the consideration would be, do you think gold is a safe investment? And if you do, then that's a good idea. And that's the beauty of DeFi. It allows us to rotate into those opportunities just like that. We don't have to go and cash out our money and then put it into gold bars or anything, or even
Yeah,
buy a stock.
or call somebody, call a broker, and they
Yeah,
have to put
like
in an order, and
go
you
to
wait like
Costco.
2 weeks, and yeah.
Get your discounted gold at Costco.
Yeah.
Actually, that is something that I wanted to speak about. I feel like when I go to Costco, I need to start I go to Costco probably 4 times a year, but every time I go to Costco, I spend at least like $1,000, because it's all the things I need. It's buying
Yeah,
cooking oil, maybe a new vacuum, and
yeah,
it makes the money back for the membership. I just need to start buying a gold bar, a couple of those little $1,000, $2,000 gold little bars each time I go.
Well, last I looked, the premium on them was huge, though.
Really?
Yeah,
Was it?
yeah,
Yeah,
Okay, never mind then.
yeah.
yeah.
I wouldn't personally.
Yeah.
Yeah, buy it
Buy
by
for
the
the
ounce. Yeah, I would buy it by the ounce and not the fractions of an ounce.
yeah.
Um, so
Yeah,
one thing
the
that
smaller the
well,
fraction, the higher the premium. Relatively speaking.
Yeah.
one thing that I think about a lot when it comes to something like PAX G or XAUT is what's the liquidity of these items
Yeah.
and how well do they track the underlying asset? Um, so, and what can I do with them in DeFi?
Hmm.
So, for PAX G and XAUT, you can supply them as collateral on a handful of different money markets and borrow against them. That's pretty darn cool. And
Well,
that's something that you,
I'll tell you a really good play, David, is you can actually loop it on Plume, the Plume portal and Plume network. You can actually invest in gold, tokenized gold, and you can actually loop it in DeFi on the Plume network and the Plume ecosystem. It's something that I've been toying with a little bit, and I've been meaning to talk to you gentlemen about and get your take on. But sorry, go ahead.
no. So that's great to know. And if you're looping gold, uh, well, you're levered long. Especially if you're borrowing stables to loop your XAUT or PAX
Very
G
good point.
exposure.
Very
So
good point.
I would just keep that in mind. Know what the max LTVs are and what the
Mhm.
liquidation LTVs are. That would be something that I would keep in the back of my mind.
I
But
am very conservative, on my loan to values. I mean, I like keeping, those very low just to minimize my risk as far as, liquidation, things like that.
Yeah.
right,
Well,
but
no, go
But
ahead.
so gold is much less volatile than Bitcoin is.
Mm,
So what that means for me is I would be much more comfortable pushing those LTVs
mm,
because if I know that the volatility of gold is such that it's unlikely to experience a 50% drawdown, well
mm.
then I could really push those LTVs and use quite a
True,
bit of leverage without
true.
having to stay up nights.
Yeah.
Well, and if we've talked about this before, keeping, some liquidity on standby, that's maybe you're just lending out that you can make liquid very quickly to buy down that position or, close it out entirely. There's a lot of different ways that you can mitigate that risk. And, I'm sure that, you gentlemen could probably come up with some way to make it a delta neutral position or something like that.
Sure.
And one of the things I would say regarding that too is like you don't have to hedge the entire exposure. That's occasionally the thing that people think that they have to do, and it really depends on your goals. Because like we spoke with somebody yesterday that was deploying like $5 million from USD into DeFi, and they want to target primarily cash equivalents and stuff like that. But they also don't mind having a little bit of market exposure. Targeted returns of 30% a year or so. I'm like, well, if we go and we just like execute shorts at a 1-to-1 rate on a liquidity pool, then when the market rips up, we're going to be over hedged, and you're not going to be able to log in on time and adjust your hedges, before the market rips up. You're going to be doing it after. And chances are on, at $5 million, we have liquidity issues. We can't dive into meme coins and do that. We have to dive into stuff with ETH, Bitcoin, blue chip stuff, meaning that the return's not going to outweigh that difference. So I'm like, why not just hedge 90%? Go and throw up a ETH USDC pool, go throw up ETH wrap Bitcoin, whatever. But like, let's hedge 90% because you don't mind having some market exposure. You're bullish in the crypto market and you want to get above 30%. And they're like, oh, that's not a bad idea, which is completely valid. We can hedge 90%, because that way we're not competing against the bull market. We still are to an extent, but we're protecting ourselves by under hedging because we know it is a bull market right now, basically.
I love the alpha.
I like it.
Well, I love the alpha and the unique viewpoints that you gentlemen bring up to these shows every time because it's you have different ways of going about accomplishing a lot of the same things, and it shows the flexibility of DeFi
Hmm.
and the different ways that you can tailor each position to meet your risk tolerance and your financial goals. So yeah, just so interesting. But go ahead, David.
Yeah, so I'm actually executing that strategy now in my own portfolio. So I'm long ETH, and then I'm borrowing ETH against my ETH, but I've also got plenty of cash sitting on the sidelines to buy further assets. I'm looking really at BNB and AVAX right now because I can borrow against them on Aave. But
Mhm.
the way that my portfolio looks right now is I've supplied ETH. I've borrowed some ETH, and I've got LPs open on mainnet and on Base on Uniswap. And so that borrowed ETH on Aave, that acts as a hedge against my positive deltas in those LPs. But what Jake was talking about, not being able to manage a position quickly enough on the upside. So in those LPs that I'm in, they're paired with stables. So that means that on the way up, I become less long in those LPs. I am, losing my positive ETH deltas on the way up because that ETH is being sold into stables on the way up. But that is not being, that doesn't take into account, the ETH that I've borrowed over on Aave. So those short deltas on Aave from the borrowed ETH, those are static. But the deltas in my LPs, those are
Re-
not.
Really quick, David. Sorry, I don't want to get too far off a rabbit trail, but could you explain why they're short?
Sure. Because I have borrowed that
Mm,
ETH. So if I supply stables and then I borrow ETH, if I just borrow that ETH and it
mm,
sits in my wallet, I'm not short.
mm,
But if I, let's say, supply stables, borrow stables, and then I take those borrowed stables and swap them for ETH,
mhm,
now I've got a source of negative ETH deltas
mhm.
at a portfolio level. And so the way that I
And
like to think
real
about
quick, I
this,
just want
Mike.
people to understand why that is. So, the fact, and please correct me if I'm wrong. So, you're borrowing ETH, say it's one ETH, and the price of ETH goes down, you still have to pay back that one ETH, not the dollar amount. And that is why you are short ETH, correct?
Yeah, so it's a classic short.
Okay.
So if I have supplied stables and borrowed stables, and I take those borrowed stables and I swap them for ETH, let's
Mhm,
say that now I have one ETH on the debt side. Okay,
mhm,
and let's say that I swapped my stables for ETH on the debt side with ETH at $4,500, let's say.
mhm,
So remember, I'm now short one ETH. If ETH depreciates in US dollar terms,
mhm,
then I can swap that one ETH back into stables and realize the difference between what I borrowed that ETH
mhm.
for and what I bought it back for. So it's a classic short position.
Awesome. I
You
just wanted to
you
make sure people understood that before we got too far. Sorry, go ahead with what you were talking about before.
Yeah, yeah. So, the way that I like to think about hedging my LPs is that you can do this in a handful of different ways. You can use your capital structure to hedge LPs. And the way that what I mean by that is um, my capital structure on a money market. So if I've, supplied and borrowed assets on a money market, if I've borrowed ETH, that's a source of negative ETH deltas which can be used to hedge the positive ETH deltas that I've got in those ETH stablecoin LPs.
Mhm,
So that's an example of using your capital structure to hedge. Now, you could also use perpetual futures to hedge your long exposure in those LPs. And as Jake was mentioning earlier, you don't have to hedge the entire exposure. You
mhm,
could hedge 50% of it, or you could hedge 90% of it,
mhm.
or you could hedge whatever you're comfortable hedging. So you can use your capital structure, you can use perpetual futures to hedge. You could also use options to hedge. However, you've got to make sure that the market that you're trading options on is liquid enough. That's the important thing. There's got to be liquidity there to trade. Otherwise, the markets are illusory. If there's no liquidity, then it's not real. So, yeah, those are three easy ways to hedge.
I like it, David. Those
Mhm.
are some great information for people when it comes towards the bear market, and even people right now that want to start to get a little bit risk off. Um, and I do want to, like, when we get the chance, we don't have to run it right now, but segue into kind of how we're trying to build some stuff like that at Metrics Finance and what we've built so far, specifically on these lending markets and stuff like that. But if Mike, if you want to dive into something else first, we're happy to.
No, this is an open forum. Wherever you guys want to take this, let's go there. I'm just kind of
Okay.
here to make sure that if we get too high level, that I slow it down a little bit for the people that are a little less advanced.
Yep, makes sense. So yeah, everybody in the chat, like, make sure, like, as I'm sharing this, please throw feedback, throw questions, throw stuff in the chat. That way
Thank
we
you.
can improve this, because this is a beta. We're kind of like not flying blind because we have user data, but we're somewhat building the plane as we go. If that makes sense, right? We're flying the plane, we're building it as we go at Metrics Finance, and that's because this hasn't really been created before, at least some of this stuff. Like, obviously, displaying lending and borrowing yields on Metrics Finance is pretty simple on the Discover section. But when it comes down to simulating what data matters most to users, that's what we need to know. And is this easy to understand? Is this how you would use it as a user compared to us? And then same thing eventually when we create the tracking portion of this. Now, this is not live quite yet. This is a complete demo, but it is live data. So we're pulling all this in directly from Aave and Compound right now. So if you've used Metrics Finance before, we have liquidity pools where you can easily see all liquidity pools across all exchanges, networks that we support. And we're branching that out to lending and borrowing, primarily because there's a strong use case, as David has mentioned before, of using liquidity pools alongside lending and borrowing, whether it's for hedging purposes, whether it's instances where you have a Bitcoin baby, I would call it, that you don't want to touch. So you collateralize that and you borrow against
My
it.
Bitcoin baby.
Exactly. You borrow against it. So that way you don't have to touch your Bitcoin, your precious Bitcoin. And that makes complete sense too. So the end goal is to have this on the tracking section, but we have to build from the ground up first. So across Aave and Compound, you can select all the chains that we support, which is pretty much all of them. You can choose your calculation time frame, just like you could do with liquidity pools. And then you're able to select between lending and borrowing. It's going to show you the borrow APYs versus the lend APYs. Again, if you think it makes more sense to have that on the same tab, let us know. But for the time being, let's just say we wanted to go on the ETH market. Now, you'll notice that this is Aave Ethereum. That's because that's the most liquid market. But when we go further on down the list, we start to get some of those other markets as well, even including like over here. This is the Lido market, I believe. The Lido market, basically, on the Ethereum network. So we support those ones as well. But let's simulate this. When it came down to simulating the kind of lending and borrowing, we thought pretty in depth about how this should work, because on one side we can make a pretty basic simulation tool that essentially just says, okay, you're going to deposit this much and you get this much out of it, right? This much yield per year. Here's like the utilization rate and stuff like that. But we didn't really think that was helpful. We didn't think that was pioneering the industry or anything like that. So how we decided to structure it is, if you say you want to simulate Ethereum, you're simulating the Aave Ethereum market right here. If you do USDT, it's the same simulation page, basically, because it makes more sense to simulate the overall market as a whole and then eventually simulate the overall portfolio as a whole on different markets. So off the bat, we have a blank slate. We can go and add an asset here. So let's just say I have some Ethereum. I have 10 ETH. I can type that in. That is now part of my supplied assets. We're earning 1.87% per year, 0.15% per month, and a whopping $2.32 per day. But that's lending and borrowing for you. We have $36,000 in borrowing power. So that means we can go and add a borrow over here, which we'll do in a sec, and borrow up to $36,000. On top of that, we can see the max LTV, where we get liquidated at, and our current LTV. So when I start to add a borrow, let's just say of 10,000 USDC, you start to see my health factors adjusted. The LTV is populated, right? And we can see that my available to borrow has been adjusted. Now, I think the most beautiful part of this is being able to see your net interest, right? Because when we go on, let's just say Aave, for example, I'll head over here real quick and let me connect my other wallet on the Arbitrum network. Here we are. You can see that my net APY is negative 1.71%. But this doesn't give me much about historicals, right? That's just the current net to APY. So if utilization is super high on USDC, I might be paying a premium to borrow that. Or I might be getting paid a lot right now, but it doesn't average out to that over time. So when we go back over to metrics, right, this is showing us truly how much we are earning per day after we pay the interest. And we're thinking, I want to get your thoughts on this in a sec, David, of having like a toggle button to basically include switch between strictly borrowing interest and strictly accumulated interest from your supplied, and then obviously the mix of net. Do you think that would be beneficial, David?
Yeah, definitely. Something that comes to mind for me though is the native yield. So the intrinsic yield for many of these assets. So let's say that I'm supplying wrapped EtherFi ETH, which has a intrinsic staking yield of what is it, like 3 or 4%, something like that.
Yeah.
So does that get pulled in too?
Not yet, but it will. So that's one of the kind of caveats that we have to run into, right? It's a question of, do we want to support all these like native platforms manually and just like individually create their data infrastructure? So instead, what we determined the solution was to use a tool like DeFi Llama to go and pull in the native yield of this specific asset. That way, we don't have to build all the infrastructure out, and we can easily just pull in that native yield. Whereas the actual lending and borrowing numbers are pulled in natively from the markets and their platforms directly. So that way, we have the most accurate data. So it will be coming. In this model, it's not here because it's under work right now. But with that being said, we can adjust that calculation time frame. So if we want to use the past 30 days of data, we can type that in. If we want to use 90 days, we can see that trend over time, how much has been supplied, even 365 days. This chart is basically just showing us the market supplied and the borrowed over time. We can also swap it to only show us one if we prefer that. Another thing I would say is as we start to add in other assets, you can see the effect of your lend and your borrow, basically. And then one of the things that we thought was super important to include was the ability to still have that individual drill down. Because the way we think about it with liquidity pools, simulate is our individual drill down. But again, we need to be able to simulate the market. So when you go on here and you click the little eye icon, you'll get that individual drill down of supplied and borrowed over time, the supply APY and the borrow APY over time, along with current liquidity, current borrowed, current available, average supplied, average borrowed, average available over your 90-day time frame. And then also the average supply APY, the average borrow APY, the max LTV, liquidation threshold, average utilization rate. And we're also introducing some other charts here. Like I want to include the utilization rate chart and stuff like that over time. So again, very, very important data points to see when it comes to creating your lending and borrowing strategy and stuff like that. Are we missing anything?
Yes. Yeah. So this is what would be. So, bro,
David
what you?
vibrating in his seat.
Oh, I mean, Jake. So Jake,
Roast us, David. Roast us.
dude, what you've built so far, man, is amazing. Like,
Okay.
dude, this is next level. What would be really great though is when you're trading on like Thinkorswim or Interactive Brokers, one of these centralized broker dealers,
Yep.
and you're trading options, let's say, you're going to be able to see your portfolio SPY deltas. So what that means is you don't have SPY is the most liquid S&P 500 ETF, and if you have a portfolio that does not contain any SPY, you can beta weight your portfolio to SPY, or you can figure out how long flat or how long or short are you in SPY terms. So the way that I like to think about my portfolio in DeFi is in terms of my portfolio ETH deltas. So how long or short am I in ETH terms? So what would be just next level here, bro, would be if you could, just connect your wallet and then see your portfolio ETH deltas. So like if I've supplied 10 ETH on Aave and borrowed 5 ETH against it, and then taken those 5 ETH and deployed them into LPs, how long am I at a portfolio level? How many portfolio ETH deltas do I have on? Because if I know that, then I can easily hedge that away if I want to.
Yeah.
So that would be really, really valuable.
Makes sense. Yeah, that makes a lot of sense too. And that's one of the things that we want to eventually introduce as well. So this is like step 2 out of 3, basically, right? We finished up Discover for the most part. Still some tweaking to do over here, as I mentioned. Simulate was step 2, and then Track is step 3, where you enter in your wallet address and you can see exactly how much you're lending versus borrowing. And see it on an overall portfolio level. And then I guess introducing an aggregate view of here's how much you have across all the lending and borrowing markets, some of Ethereum, some of your borrows. That would be a pretty useful feature to include, I would say. And then also, I think across your liquidity pools, having that same sum. Here's how much you have in your liquidity pools right now. Even though that's going to fluctuate a lot because of the LPs, being able to see that on number one, an aggregate for the individual categories, and then also for the entire portfolio would be very, very useful. And when you think about that, David, are you just looking for ETH and Bitcoin, or are you looking for all assets, let's just say, including altcoins that you have paired with ETH or something like that?
Yeah, I would be only interested in calculating my ETH or BTC deltas.
Okay.
That's what I would be. Now, let's say that I've got positions on Solana
Mhm.
or on Sui. Well, then I would want to know what are my Sol deltas or what are my Sui deltas.
Yeah.
So that would become important if I were operating on one of those chains. But I live on ETH mainnet.
Okay.
So for me, it would be most important to know what are my ETH deltas. That would be most important for me.
Okay. I'm just noting that down basically. So essentially how that would work is we would show let's just say I'm lending out some BTC, some not CBE, some Aave, let's say, and some Link, right? And then we also have that ETH chunk that we have. So we have 100 here, and we have 1,000 here, right? Then what this would essentially do, David, is it would aggregate the total dollar value right here of, in this instance, $98,000, and find out how many ETH is worth $98,000, and say it's about 18 or something like that, right? And then that would basically just say, okay, you have 18 ETH exposure right now. So then you can go and short 18 ETH. Is that how you view it? Or am I thinking about this?
Close, but not quite. I would use a correlation coefficient.
Okay.
So if I'm long Aave and long Link, I would first determine if I'm long 100 Aave tokens in ETH terms, how long is that? And I would use a correlation coefficient to calculate that.
Okay.
So that's the way that I would go about it. I wouldn't use the US dollar value and then say to myself, well, if this were ETH, I would then be long this many ETH. I would instead say, okay, well, I know this US dollar value. This is how many, Aave tokens, how many Link tokens I'm long. This is the US dollar value. But I know the correlation coefficient between Link and ETH and between Aave and ETH. And so I would multiply the US dollar value of the position, let's say the Aave position, I would multiply it by the correlation coefficient to determine how many ETH deltas I am long with that Aave position. That's the way that I would do it.
Gotcha. You're gonna have to help us with the math a little bit there. but I get the concept, right?
You see what I'm getting at, though?
Yeah. That makes total sense. Yeah, and that seems a little bit more accurate than essentially how we were calculating it. I think we could have two modes too, where you can swap between dollar value terms and this correlation coefficient terms.
Yeah, but I think that one method of calculating is valid and the other isn't.
Okay.
I don't think that it's valid to say that if I've got $100,000 of ETH and $100,000 of Aave, that I've actually got $200,000 of exposure to ETH. I don't think that
Yeah, of
that's a
course not.
valid
Of course not.
way.
No,
Yeah.
no.
What
What
I
he's
more
saying
mean
is
is
just
like,
being able to gauge it.
yeah,
U.S.
yeah, like
and yeah, I know what you're saying, Jake.
portfolio value in ETH, for example. Like, because a
Yeah.
lot of the clients like we work with, they're like, okay, I got BTC, I'm selling BTC to kind of get into like these liquidity pools and stuff like that. So then what they gauge is they gauge their overall like profit loss in BTC. They gauge their overall current liquidity in BTC. So I don't, and more of like, I started with 100 BTC that I sold to get into these strategies, and now I have like 102. Boom, that's a 2
I,
BTC
that,
profit.
I
Or
that's exactly why I think both would be valuable from very
yeah,
different.
yeah, yeah. And then the
Yeah,
other one being used more for the hedging side of things, right? Not
exactly.
just gauging growth, but gauging more of like we need a short exposure or something like that.
Well,
Um,
Jake, I know that your
For sure.
mindset, like especially with the way your portfolio is now, you've mentioned it last time, last show, that you're more about, gaining exposure to an asset,
yeah, yeah, yeah.
building more tokens. So, that way of measurement that you're talking about would be valuable for people that were that was their goal, or that was their financial financial goal, is to build more exposure to an asset. Whereas David, and what he's talking about is more about, seems to me, and please correct me if I'm wrong, David, but
Mhm.
somebody that's more about earning yield to live off of, kind of like you're doing currently.
Yeah.
Yeah, yeah. I mean, look, I live off of my DeFi portfolio. This
Exactly,
is
but
what
there's
I
different
yeah.
people that doing different things, and so basically my point is I think that it would be valuable to have both. For
I
people
think
that are just trying to build their positions, and people that are looking more about ensuring a stable income because they're living off of their yield.
I think
You know
so
what
too.
would be really cool too, Jake, is if
Yep.
you could put in some type of like a Sharp ratio, to figure out like on a risk adjusted basis, how well am I actually performing? That would be
Okay.
super cool, especially as we start to build out fixed income portfolios. I
Yeah.
think that would be super cool.
So when you say like, set your Sharp ratio, do you mean like literally just go in and be like, my Sharp ratio is 3.5% a year, or this specific Sharp ratio, or do you mean more of like my Sharp ratio traces Bitcoin return over time or something like that?
I would want to know what has been my historical Sharp ratio for my portfolio or
Okay.
for an individual position that I'm in.
Yeah.
That's kind of what I'm thinking there.
Gotcha. Okay. Yeah, that makes a lot of sense, man. Um, so yeah, I jotted down some notes on that. And just to like kind of wrap this segment up, right? What I want to show you regarding like simulating the performance. Again, there's a couple little quirks right here still, but the goal is to be able to simulate your overall borrow over time, and see what happens over time, basically. So in this instance, where we're say borrowing 40,000 USDC, let's just say. It's costing us about $3.30 a day. What we're aiming to do is be like, okay, well, how long until liquidation, right? If you continue at this, it takes this many days until you get liquidated. So that way, oh, shoot, like if nothing moves and I just get liquidated, it's going to happen after 20 days, 200 days, 500 days, whatever. But also saying, what happens if prices move? So if the Bitcoin price, or sorry, ETH price moves to 5 grand, your Aave goes to 315, Link goes to 30, right? It's going to adjust our health factor. It's going to adjust our LTV, and we will have a higher amount available to borrow. And then on top of that, the overall goal is to be able to see what happens to values, but for some reason we're displaying the wrong value right here. So ignore that. But that's how much we're going to earn per day, basically, now that our portfolio is at a higher value. But yeah, I mean, we could see over time how that adjusts the overall position health. And that's the goal. So after you simulate, ideally we would be able to track the portfolio, which we're working on right now. And that's just entering in your wallet address, seeing across all lending and borrowing platforms exactly how much you're lending, how much you're borrowing, an aggregate health factor, your LTV across your entire portfolio, your net interest, or even your supply/borrow interest across the overall portfolio, and many other factors. So again, opening it up to anybody in the chat. Let us know if we're missing anything. Let us know if there's anything that you guys want to see as part of this implementation. Obviously, this is V1, and it will continue to evolve. We're planning on releasing this soon. I'm excited to do so. So yeah.
No, very excited to see it. And I mean, my question would be, are there any functionalities that you're going to be adding eventually for looping?
Yeah. So like that's one of the things that is actually somewhat tricky, Mike, to think about like
Oh,
user
sure.
experience wise. So like when you think about looping, you might start with 10 grand and then you lever that 10 grand up. Ultimately, your borrow might be 100 grand and then your borrow might be 90 grand and then your lend might be 100 grand basically.
Mm.
Um, so ultimately, what we plan on doing is having like a button over here where it's like add loop. And then it's like it asks you how much leverage you plan on adding, right? And that
Okay,
will
yeah,
automatically calculate like the amount to lend versus borrow basically. And then
mhm.
ultimately that will just pre-fill that data. So that
So,
way
so
you
so
don't
almost like a simulate the position kind of thing.
yeah, so that way you don't have to go in and manually calculate outside of metrics like, okay, if I lever up by this much, right? If I execute a looping strategy, which if we just go to one of the ones that I'm running over on Jupiter, let's say, with
Yeah,
that
basically
multiplied.
plug in what's my borrow APR, what's my lend APR, what's my loan to value, all those different variables, and then
Yeah,
yeah.
yeah, exactly. Like if we look at this, I'm supplying 35.1K Startup USDC, borrowing 25.4K USDC. So ideally, what we would have on this integration, and sorry, I was sharing the wrong tab, as you can see over here. Ideally, what we would have on this integration within metrics is the ability to click like loop or something like that. It would have
Mm.
like a little pop-up. It would say, what asset are you supplying and what asset are you borrowing? And then you would be able to, and like obviously net value, and you'd be able to adjust that leverage slider basically. And then from there, that would automatically calculate the amount that you need to supply, and you'd be able to click import and import it directly into metrics. So that's how we would do it on Simulate. Now, on what do you call it? Tracking, it's a little bit different because we're not able to analyze outside of the window of like a transaction associated with the actual smart contracts, right? Like if you go and execute a trade, after you borrow some USDC, you trade USDC for ETH. We don't know about that trade basically, or at least the system doesn't, and it's too much outside of the scope in order to build that out. That's where we're becoming basically like a tax tracking software, like Coinly or something like that. So our kind of plan is to, just like we have with liquidity provision, make it so you can do a manual override of the actual asset value. So that way, when you start looping or something like that, you can override and say, this is how much I paid for it. Or you can attach that borrow specifically to a supply. Like after you lend it out, right? Say you borrowed 10 grand, you swap that 10 grand into ETH and you got 99.80 out of that ETH after the swap. You'd be able to attach it. It would automatically transfer that cost basis over as 10 grand because that's what you swap for it. And then ultimately you would be able to essentially view your overall profit loss from that regard, basically, just for looping in specific. So,
Mhm.
do you see a better way of doing that, David or Mike? Just
I
from the
mean, I was hopeful that the tracking portion of a loop that would be easier to track, but you're right. If you swap some of the supplied or borrowed assets,
Mhm.
that would make it much more difficult to continue to track it properly. Um, I don't know, man. I mean, I guess if you use a separate wallet for a fixed income portfolio, you open positions and then you let them run and you don't really mess with them all that much, then I mean, I would love to be able to track, fixed income positions on metrics using the track tool. That would be phenomenal, man.
Kindle
You
and
know,
stuff?
yeah, Pendle PTs, looping
Well,
PTs.
That's on the
well,
roadmap. Yeah, that's on the
well,
road.
what if? Well, I mean, and I'm just spitballing here, but David, that's a good point. Using different wallets, in the track feature, you can add multiple wallets and metrics. So, what if you had a different wallet for kind of each of your each of your strategies, or if one of them is income generation, the other one is asset building, whatever. I mean, could that be a workaround?
I mean, I would say somewhat. Like we already have the ability to paste in multiple wallets. I think, creating like
Exactly.
naming and stuff like that and then save to like almost your account as opposed to just like the recently ones. So that way you could just be like, click this wallet, click that wallet, and easily see that performance. The main thing is just like how can we make it so it's super seamless, it's barely requiring anything for the user, and unfortunately it's in my opinion impossible to make it completely automatic when you start to introduce like looping as well as start to introduce, what do you call it, like borrowing against your liquidity or borrowing against your supplied assets for liquidity pools. There has to be like a classification of, hey, I took this percent of that borrow and I parked it in these liquidity pools. Now, will metrics be able to say, okay, literally just drag like a little icon, like, 10K borrow, drag, boom, 30% to this liquidity pool, boom, 50% to this one, boom, 20% to this one. Sure, right? But you're still going to have to go in there and drag that because we truly don't know which capital went where and we're unable
Well,
to build that.
pretty much any manual process aside from data, pulled directly from, on chain is going to throw a wrench in the gears for sure.
Yeah. So we want to make it as hands off as possible. But when it comes to those like more advanced strategies, I would say it will require somewhat minimal effort. Now, our goal is if you're using a tool like DeFi Saver or InstaDApp or any of those, right? We'd basically be able to do it all in one transaction, because what that does is that essentially says, hey, in the same transaction you supplied 100 grand and then you borrowed 90 grand, right? And that's the exact numbers, simple as that, right? We can easily track that. But when it comes to like doing some of these processes manually and you're executing across like 10, 20 transactions, that's where it starts to get a little hiccupy and confusing. And yeah.
So, Jake, I think that, the end state that I would love to see would be, let's say that you've got $1 million fixed income portfolio and you've
Mhm.
got 30 positions in that portfolio. I would love to be able to just connect the wallet to metrics and then immediately see my net APY, how much I'm earning each day and how much I'm earning each month, and then a handful of different like risk simulations.
Yeah.
Like, dude, that would be next level, I
Okay.
think.
Okay. Gotcha. I like it, man.
It's I don't know how you're gonna do it, but like
Yeah, well, there will obviously be the
David's
limitations.
like, I'm the idea guy.
Yeah. Well, it's all like a lot of it comes down to the platforms that we support. So like, now that we're branching off of liquidity pools, going to Linden and Bar, and we'll start with the Aave compound, we'll move over to Camino and other Jupiter and stuff like that, and other Linden and Bar platforms. Go down the list, get the top ones supported, just like we do for liquidity provision, and then we'll move over to fixed income like Pendle and other platforms like that. And we'll still always for each of those segments like Linden and Barron, for liquidity pools, and even when it comes down to fixed income and stuff like that, we'll always have the manual option, which we're working on improving and like making that semi-automatic, so that we could pull in more of that. So that way, if there's something that you open up and we don't support it, you could still see it on metrics and you could still have that on our dashboard. And then eventually, we do want to like move to aggregating the data that you would normally see on DeBank and Jupiter and stuff like that. We just won't be able to show profit loss from that what do you call it, perspective. We'd be able to show you overall allocations, pull in specific aspects like, hey, we support Uniswap, so we can pull in Uniswap profit loss and show you on that. We can't pull in HODL profit loss. We can't pull in stuff that we don't fully support natively. But yeah.
hell yeah, man. Hey, did you see in the
All right.
chat? DeFi Don says Soul is Pumpy McPumperton. Yeah, man, we're seeing a little bit of a move as you've been speaking here. Maybe it's because you're talking about this awesome tool, Jake. I think you should keep
Yeah,
doing
talking about going over to Solana Network on Linear and Barring, and
yeah,
the market's moving based on that news.
Yes,
So,
I'm
yes.
sure.
yeah, I just want to say I appreciate everybody's feedback regarding this, because again, that's what's going to shape this tool. And again, a lot of the stuff that we're going to build, V1 will come out and literally just go on our live chat, flood the live chat with all the ideas, basically. And our AI will respond to you, and then eventually a human will come and respond to you within the day. And then ultimately, that's going to help us kind of build the product even better. That's how it went for custom positions. And even, when we're just liquidity pools and stuff like that. So I appreciate it, David, appreciate it, Mike, and appreciate everybody in the chat.
Oh, absolutely. And so this last question just says, and I believe I know the answer, but it says, "Hey Jake, how about a page that shows overall held balances and wallets similar to CoinStats?"
Yeah.
You want to?
So, regarding that, right? What I was basically saying earlier is there's DeBank, obviously. So if I were to pull up DeBank, right, we can view overall portfolio value, and it's basically acting as a snapshot of what we have right now. Like, it doesn't track our profit loss, it doesn't track any of that. It just shows us, here's what your portfolio looks like at this given time, basically, which is actually very useful to be able to see where you have money and stuff like that. But like drilling down in the profit loss, we can drill down into the profit loss for HyperSwap, PancakeSwap, Uniswap. Those are all platforms we support. Soon we'll be able to drill down into it on Aave and all these other lending and borrowing platforms. But if you're on another platform that we don't support, or you have your hodls, we won't be able to show profit loss or anything like that. What we can show, though, is current allocations and metrics. So we plan to basically create something like DeBank that basically just aggregates data from everything. And we're going to pull from a DeBank API, basically, or another tool. And then we'll merge it with Solana. So that way you can paste in both wallet addresses and see everything on one page instead of it segregated. And then for what we do support, like eventually Aave, you'll be able to view a drill down. There'll be a button here. And when you click that, it takes you to view that specific market on metrics, drill down where it actually shows you profit loss. And then stuff that we don't support won't have a drill down, basically. So yeah, that's kind of like the goal again. And as we support more and more stuff, eventually like it'll become better and better and better. And that just comes with you guys letting us know what you want us to support and seeing how many requests we get. So yeah.
Absolutely. Well, gentlemen, I know that you're both busy individuals, and as always, I just want to be respectful of your time. We're done with our hour, but thank you as always for being here. And Jake, if you're free on Friday, me and David have the show then. More than welcome to join us then.
Okay.
But closing thoughts, Jake.
Nothing on my end. I just appreciate everybody sharing that feedback and stuff like that. It really helps shape what we build, and appreciate you and David coming on a weekly basis as well to help improve the product and also share your thoughts on DeFi. So,
absolutely, David. Closing thoughts.
Yeah, I'm taking a look here at ETH and Sol making a nice move. Looking down the list at Hype, $57. ENA, ETHFi, SPX moving to the upside. And when I look at Bitcoin dominance, I'm thinking to myself, well, Bitcoin dominance rolling over again. And if we get, a push lower in Bitcoin dominance and ETH is able to break above $5,000, then you guys, we're going to see, I think we're going to see alt season, so I'm very excited, man. Let's go.
One thing I want to say on alt season real quick while we're on the topic, Aether, one of the tokens that I've been bullish on, it's kind of like Render or something like that, but more for enterprise grade GPUs, doing over 100 million a year in actual revenue.
Aether is a beast.
Bringing that back into the ecosystem, it had a decline for a good period of time. Held my bag though, and within a week up 85%, and now we're double in price. So going from a price of 3 cents all the way up to like 6.3 cents right now. So definitely a good hodl. And at its the revenue that they generate compared to a lot of DeFi projects, there are multi-billion-dollar DeFi projects that either have no revenue like Uni, or B, they have no ecosystem integration. Aether has both, and it sits at a $770 million market cap, and it generates over $100 million a year in revenue, which is nuts. So yeah, I just wanted to kind of share that because that's one of the positions in my bag. Also Hype that has done really well over the past like 2 weeks, and it just it makes me very bullish on the crypto market and ensures that confidence in me that we're going to see that altcoin rally eventually. So yeah.
Awesome. Well, gentlemen, I appreciate you. And until next time, Veteran Crypto out.